Looks like Master Trader's having a good day. Awesome. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Yeah, happy Friday the 14th. Hey, that's not bad luck, is it? Oh, but Friday the 13th is bad luck? Only if you're a Templar knight and the Pope is worried that you've grown too powerful. So anyways, I think that's why Friday the 13th is bad luck. So, but I'll tell you what, Friday the 14th is good luck. Good to see you. Good morning, everybody. How you doing? How you been? How's your week going? Master Trader, CAD yen up 145, Swiss yen 140, Euro dollar 76, Euro yen 401. Very cool. That's how you do it. What's this? Brad's? Brad doesn't have a bias? Is that right, Brad? Brad's a smart guy. Anyways, welcome to Forex.Today. Now 15,100 foreign exchange traders stationed around the world. We get together as a community at 9-ish every single morning to align our satellites, synchronize our watches, and get ready to kill. We're killers. We're hunters. So we're out here, cool, having fun, doing technical analysis, doing fundamental analysis, and doing trade planning. Right? Yeah, Brad's a smart guy. There's no, there's no way, man. So, anyways, yeah, Brad's messing with you. I figured as much. Anyways, cool. This is the place to be. Yeah, cool. Right on. Some master traders putting together a portfolio. Really cool. So, yeah, I think every single day for the next 30 days is going to get better and better and better. And let me say, now we're not quite halfway through August, but pretty close. And I'd like to say August was pretty good compared to many Augusts. And July was actually pretty good compared to most Julys. So we have a lot to be thankful for. And then now we got to prepare for the end of the year and the election and all that kind of stuff. So this is awesome, right? Right? So we have a lot to be thankful for. I'm thankful that you're in my life. You give me the strength and courage to get out of bed and do the things that need to get done. So cool, awesome. So I've been a currency trader for 20 years. I've been in the high-tech startup and venture capital industry for not that long. So I've been a Forex trader, I think, most of my professional career. I have made 100 investments as a venture capitalist, that kind of stuff. I've run companies of 3,000 people. I've grown companies from 3 people to 300 people in 18 months with no investors. So I've done a few things, and I bring that along with me. Now you've done a few things over your life, and you're bringing those good things and some of the bad things along with you as well. And we're on this journey together. And our struggle often is internal. We're trying to be the best we can, and constantly challenging ourselves to improve. And that's not a journey you want to do on your own. So it's really cool to be working with you. Not just on making money, but like that's the easy part, right? The other stuff is, I think, a lot more complicated. So thank you for being in my life. I'd like to thank Traders Way for being the sponsor of our community. You're a Forex trader. They're a Forex broker. Why don't you give them a chance to earn your loyalty and respect? That's all they're asking for. They're not like, hey, Wayne, help us get a whole bunch of clients and we'll put on a whole bunch of money and we'll get rich. Whoa. That's not what it's about. Okay, they want to show you that they don't mess around with your trades. They don't mess around with your money. You pull the trigger, they enter your trades into their interbanking system, and they do it really quickly. They charge very small fees for this service. They provide maximum spreads they possibly can. I'm like, oh my God, that's what you want. So they're your execution partner, and they're hoping through education that you'll have a successful Forex trading business, right? So, The table's set, the candles are lit, bloop, 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 bloop. The wine is poured. So tradersway.com, give them an opportunity, huh? By the way, if you like MT4, if you like MT5, I have chart templates for them. If you like to read, I wrote a book. If you need video training courses, there's stuff there. There's a lot going on. There's a lot of resources to help you. All the links are in the description below. Okay. Cool. Nice. Master Trader says, I see with your methodology, 1,000 pips are like loose change. No, I've never said that. 1,000 pips is nice. Okay. So most people remember the first time they ever make 1,000 pips in a month. Okay. Depending on market conditions, so depending on the beta, some years, and I don't expect it this year, although it could happen, but in certain market conditions, when you're thinking that you're going to be in a trade for, let's say, 100 days, see, most people can't think more beyond 100 minutes. And then you're like, you should be in this trade for 4 days, eh? A whole week, right? You should be in a trade a whole week. A whole week, that's like 100 hours. So I'm saying if you're in a trade for 100 days, but in that course you were able to open up, in the course of that time you were able to open up 30 or 40 trades, yeah, then you'll remember your first $10,000 pip month. I mean real pips. I don't mean like exotic emerging market pips where each pip is worth a quarter of a penny. No, I mean, you got 27 Japanese yen trades long in over 100 days, right? You're right. Anyway, so you'll do it. You'll do it. Barry says, I made 1,200 pips last month on gold. Cool. I'm not sure what you mean by pips, but I think I see what you're saying. I mean, good trading is good trading, right? That's all. That's very good. So I'm glad that you guys are finding your success. I mean, really, I'm proud of you. This is a hard gig, I know. Okay, let me start with the indices. Oh, what's the difference between alpha and beta? Beta is the market. So what are the markets doing? So let's say in an average day, the market goes up 100 pips. So how much of that do you catch? Okay. And then of course, you can look at it as an average and how much above the average do you beat? Your alpha is your decision-making process. Okay. Think of it that way. Your alpha is your ability to beat the market. And now, if you beat the market and you're like, I'm doing 30% a month and the stock market's doing 30% a year. You're like, whoa, dude, you're doing 30% a month? So you have to think a bit like, how do you outperform the market so much? How does your alpha beat the beta by so much? And of course, a sophisticated investor is going to do a risk-adjusted analysis and see that you're doing it through leverage. And they're like, I'm not really interested in leverage. Thank you. Good luck. Okay? So I think your potential investor would be tickled pink if you could say, I make 10% a month, not 30. And I do it with low volume and low volatility and consistent returns, right? And almost never a drawdown. You're like, okay, even 10% would be very hard to justify. Okay? So your alpha is your ability to outperform the market because you made better decisions, but not because you took more leverage. Okay, you see? So even if you have good returns, a sophisticated investor is going to knock down and discount your returns due to leverage. Okay, they're going to look at it through the lens of some sort of model. Maybe they use like a CAPM or something, and I think they're silly, but like for example, if you were doing like stocks or something, right? So let's say you were a stock market trader. You would do something like capital asset pricing model. See if I remember this right. Okay, so CAPM is equal to the expected return of a stock, let's say, or the expected return of whatever asset. And that is equal to, and this gets complicated. First of all, you have to look at your alternative investments. So this is your risk-free rate of return, right? And then we got to then do the market. So your risk-free rate of return, so that's if you invested in the 10-year T-note, for example. Or you could use it like a discount rate and say it's not risk-free, let's say similar risk, you can invest it somewhere else, but whatever. Your risk-free rate of return, and this is the Greek symbol for beta. Now, what is it? I guess what you have to do is separate the market, right? So this is now, I guess you'd have to do the expected return of the market minus, does anyone remember of this one? I think you have to take off the risk-free rate of return again, minus the risk-free rate of the return. Does anyone know if that's right? Okay, and so they're looking at what this will tell you per se is this beta will tell you, right, how much the market generally would move with this investment, and then subtracting out what the market is doing in general, so the investment inside that market. Okay, so for example, like what if you were talking about the real estate market and what is the average return for this market minus that risk-free to get sort of a real return, right? And you're trying to figure out what the market is doing, then what your investment is doing, and you might find out your investment is producing much, much, much higher returns. Well, how did you get that? And maybe you bought something super cheap because it's dilapidated. So you bought it cheap, but it needs $3 million worth of investment or something, or vice versa, or whatever. And maybe it's underperforming because you paid way too much or something. And so there's going to, like, the point is you wouldn't use CAPM and Forex really, but someone would be thinking like us. Okay. If they're a sophisticated investor, they're going to look at your analysis. And even if they're not using this, this is how they're thinking. They're saying, if this person is returning this much, and this is what the market's normally turning, if there's a dichotomy, if you're underperforming, they're not interested, right? But if you're way overperforming, they're going to say, what the WTF does this person do? Okay? And it'll be a red flag. Ideally, you outperform the market consistently, but not sort of exaggeratedly. Okay? Because if it's too much, they're going to say, how did you get that way over performance? Like, how did you make 1,000 pips on the pound yen when the pound yen during that period only moved 100 pips? How did you do it? You're like, well, I didn't make 1,000 pips. I took 10 times the lot size. And they're like, okay, we're not interested. Okay? So you have to think of it that way. My point is that they will look at it through the lens of risk-adjusted performance and try to figure it out. And if you make big money, be prepared. Okay? If you make big money, get prepared for them to identify this as a big risk. Okay? And do you think people that are already wealthy are interested in your big risk? No, they're already wealthy. They want you to protect their money, not risk it. And so they'll look at it like, okay, you're making big returns on a small amount of capital because you don't have any money and you'd rather take the risk because you need the reward. And all of a sudden they're like, this guy thinks poverty. Okay? So you have to temper that, and instead of big money, what you have to understand is what wealthy people want is consistent, Not even returns, income. Okay? Okay? Yeah, if you lose big money, yeah, you're not a professional, right? So wealthy people want to know that their principal investment is protected and the likelihood of you losing some of it is very, very, very low. All of it, the world would have to end for that to happen, right? So what they want to do is put money with you and know for a fact, well, not know for a fact, but feel confident, 100% confident they feel that if they invest with you, you're going to put, let's say, at least 38% a year in their pocket. Okay? And that the best stock market we've had in the last 10 years was 30%. And typically it's only producing 18%. And historically it's only producing 8%. And they're worried about it being way overbought and crashing at any moment. And they're like, you know what? I'd rather take some of my profits out of the stock market and give it to this Forex girl. Because she's great. She's consistent. She's shown me over time that it's almost impossible for her to lose my principal, but over the course of time, I can collect income from that. I want to go with her, especially if the stock market looks like it's about to drop again. I'd rather give it to her because she's going to provide consistent income. Okay? The same way, right? I don't think the stock market truly is a competitor. I think when the stock market is set to climb, or sorry, to crash, let's say you're at all-time highs, and your analysis shows you that you think over the next 6 months to a year, the stock market's going to roll over, that's when you should do a raise. You should go out and start talking to investors and say, hey, if you ever feel like, your stock market positions are vulnerable and you want to move it to another asset class that's liquid and can make money on the downside of the general market, give me a call. Okay? If you're going to cull the herd on your stock market and goes to cash, give me the cash. Okay? And right, so it's think of it more like if you bought an apartment building, it's going to go up, let's say 5% a year, right? So if you put in 1M, you can expect it to go up 5% a year. The thing is, you can't eat the 5%. Not until you refi or you sell the property. So after that, you have your rent minus your expenses minus your financing costs, and maybe at the end of the year you collect 15%, okay, internal rate of return. So if you're producing 38, they're like, holy schnicker schnocker. Wow, seriously? Wow, seriously? You're doing 38? My apartment buildings are doing 15. You're like, oh, well, that's because we're liquid. You don't have to wait till the end to sell the property because you'll make most of your money selling the asset, but now you don't have an asset. And you can't eat your profit until you get rid of it, so you live on this tiny little income. But here's the thing, I'm always 100% liquid and mark to market, so we can trade our profits and live on the income. And there's just like silence. No way! And you're like, get ready for it. Boom! And their head explodes. Whoa! Whoa! Hey now! Whoa, whoa, whoa. So never think about like this whole get rich quick stuff. Don't think big money fast. Don't think about all of that. Think long term, think about being a business. But most importantly, at the heart of this has nothing to do with you. I want you to think about everything from the point of view of your client. Risk, they don't want your risk. Okay. KG says, now I just need to make 100,000 to live off of. Yeah, well, the cool thing is, I want you to think of it this way too. You're always going to make money off your money. Here's the secret to your billions, right? Your money. Stop thinking about becoming a professional trader, let's say, and trading other people's money so you can get rich. Whoa, 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 whoa. That's not how you do it. You don't become a brain surgeon because you think of how much money you're going to make. You're saving people's lives. Okay? You'll always make the vast majority of your money from your money. Then you have your client money. And you love your clients. You're there to protect your clients. Okay? And you provide them a valuable service. Did you hear it? Value. You're providing them a valuable service. You analyze the data, and when most people are unwilling and unable to analyze the data, you make good decisions when other professional money managers are unable or unwilling to make good decisions, right? You are risk adverse when everyone is going for gold, right? You are a value provider, not a get rich person, right? So here's the thing. Your clients get at least 80% of the profits. Over here, you get 100% of the profits. So here's the cool thing. You ready for this? Who said they need the 100,000 a year? By the way, when you get 100,000, you'll need 150, Barry. And Barry, when you have 150, you're like, this ain't shit. I need 300, right? What happens is you upgrade your life over time. There's always a reason for a little bit more. But here's the thing. Here's your secret. Okay, Barry? You're providing value to your clients because you're a value provider. And you're making 100% returns on your money, and you're making 20% returns on your client money. You want your client, right? Your 20%, okay? Their 20% should provide you your 100K. Why? Why is this the secret sauce? I mean, you've never heard this before. You've never thought this way before, but this is where you need to be. You need to have enough assets under management and enough returns so that the 80% of the money goes to your clients and what's left over goes to you, and that's your 100K that you live on. Why is this the secret sauce? Because just like the value you're offering your clients, you are offering to yourself. You don't touch your principal. And like I've told you before, you turn 50K into 100K in year one because you didn't eat this, and then in year two you turn 100K into 200K in year two because you didn't eat this. You're eating this, and then in year three you're turning 200 to 400. Year four, you're turning 400 to 800. And at the end of year five, you have $1,600,000. $1.6 M. You are not only a millionaire, because by the way, everybody in California is a millionaire, but they're all dead broke. So that's not a real millionaire. You have 1.6 million liquid cash, and over that period of time you earned 500,000. So in 5 years you're worth more than $2 million. 2 million. It's 2.1. I get it. Do you understand? The less you pay yourself, the more money you're going to make. Now here's the thing. In year 6 you grow it again. Year 7 you grow it again. Year 8 you can't even see year 8. You can't even see your logical mind can't even see this far. You can't even see 5 years in advance. You're going to talk yourself out of it. You're like, this is bullshinarchy. There's no way. I can't do it. This is smoke and mirrors. That's impossible. Yeah, maybe for you. if you think that way. Right? But if you have a true 10-year plan and you're focused on not getting rich, but providing value to your clients, therefore providing value to yourself, your good clients, your wonderful, beautiful clients are helping you grow. You're not living on the back of their money per se. They're supporting you and you are supporting them. And together, because of your value creation that you offer to them and to yourself, you will be more successful than your wildest dreams. Or you stay poor. Because you make 50 grand, you eat 50 grand. Then you're at zero. And then you make 50 grand, and then you eat 50 grand, and then you're at zero. And this type of living is paycheck to paycheck poverty. Because you own zero assets. You are by definition poor. You eat your principal. That's not what wealthy people do. Wealthy people have this big stack of money. You're like, I don't have that kind of money. Well, you have to get that kind of money. They sit on this $1 million, and every year the $1 million spits out, let's say, 100,000. And their whole life is about living off $100,000 a year. And they can do it forever now. As long as they have low volatility and consistent returns, right? That's 10% return. And then you show up, you're like, well, how about 25%? And they're like, dumbass said what? Like, yeah, well, what if you took the same amount of risk, stayed completely liquid, my trading is completely transparent, and instead of you living off of 200 or 100K, what if I could help you live a lifestyle where you live off of 250,000 with similar risk and a lot more safeguards? Would you be interested? Holy crap! And then you could do things like, I will give you a look back provision. Or, no, let's not do that. Let's not do a look back. They wouldn't care. I will do this. In fact, I will promise you, I will not get paid from the performance fee until you get your $100,000 back. And then we split the other 150, 60% to you, 40% to me. But I don't get any performance until I until I return this 100,000 or give you this 100,000. Now I also pledge and promise I will not do it from increasing risk. Oh my God, they're just like, they're gonna have a heart attack. They're gonna have a heart attack. Oh my God, you're gonna take the same amount of risk. You're gonna take the same amount of risk and guarantee my 100,000 up front, and then after that we split. Oh my God! I mean, you can negotiate anything you want. This whole idea of like, oh, the watermark and having your traditional 80-20 and all, that's so boring. You're gonna sound like the other 200 people they've talked to. I would structure my contract completely different. Why? Because I have that background. I know how to structure a venture capital contract. I know how to structure a real estate contract. I know how to do licensing contracts. I know how to do, Forex money manager contracts and hedge fund contracts. I would just say, you know what? I'm going to do something way better than you've ever seen before. Because I'm going to pull all the best things from all these other industries that protect the client and ensure the client gets their expected returns. I'm going to design a contract that will protect the clients first and foremost so that it reduces their risk as much as imaginable, right? Imaginable. We will reduce the risk for clients as much as we can, way beyond what any other hedge fund has ever offered before. Because it comes to the clients, guys. Because the reason for it is if you can get clients, you don't touch your principal either. You protect that. You put that in a vault. Just like your clients. And when you're ready to retire, whenever that is, you can be as filthy and as stinking and as rich as you want. The only thing is, will you retire in 5 years with 2 million? Will you retire in 8 years with 5 million? Will you retire in 15 years with a yacht and a plane and a helicopter and go on YouTube and say, I'm the #1 real money Forex trader and I have a jet? Okay. Well, the thing is, it's just time. How long do you want to do it? Here's what I think you're going to do. Okay. I think what you're going to do is take, let's say you're living off your client money, and now you have enough assets under management that you're making 250,000, not 100. But now you got this stack of 5 million. You can keep doubling it and doubling it and doubling it, but let's just say it wears you down, right? It wears you down. And you're like, well, I don't necessarily want to keep trying to double it because bad months are really, really bad. And you're like, I want low volatility and consistent returns. And I need income and I need asset appreciation. So you're like, I'm going to take the 5M, okay? And I'm going to leverage this up, okay? So you put in 5M into a project. And a bank puts in 20M. What the? You have a silent partner? How much do you have to pay them? Oh, you have to pay them 40%. No, not 40%. 4%. What? Yeah. You put in 5M, you get a silent partner. They don't tell you what to do. They don't wake you up in the middle of the night like, I think you're making a big decision. They pony up big, big money and they're like, but you have to guarantee us we get the first 4%. Ha! What? Oh my God, I was paying my clients 80% in Forex. Now I can pay you 4% and you never complain? Oh my God. And now you put that into this real estate deal. Okay? Net operating income minus, right? Subtract your 4%. And guess what? Now you have this $25 million apartment building that appreciates 5% every year. And you pocket money. I guess you pocket money. You pocket money every year, what's left over. And in 10 years, you sell this thing for 35 million, and now you've had income for 10 years. And then you sell it, and you put another 10 million in your pocket. And you did nothing for it. And now you're thinking like your client. You understand? But the thing is, your client already owns 5 apartment buildings. So like, I don't want another apartment building. What do you want to do? Well, if it's only 5M, why don't I throw it your way? And let's rock it, man. Let's have some fun. Because they're like, I got enough of these things. I don't need another one. Real estate becomes a problem because there's a trap in here where you get to the point where you can't sell even if you wanted to. So anyways, I'm trying to frame all of this, guys. I'm trying to frame this, right? So I want you to think of yourself as a value provider. If you think about yourself and not your client, I don't think you'll succeed. I don't think you got it. Okay? Honestly, I want you to think about what I shared with you today and say, oh, I get it. I need to be a consistent trader with low volume and low volatility, right? So that my performance is attractive to potential investors that already have money, that already have wealth. And then you have to show them the benefits of the foreign exchange market over their other alternative assets that they're looking at. And that you are a value provider unlike anyone else they're talking to. And they give you a shot. And the reason you need this so bad is you need to provide the value to your client so that you can trade along with them, keep 100% of the money, of your money, keep 20% of their money, and you can live off the 20% so that you never touch your principal and you let your principal grow and grow and compound and compound and compound until you're the one looking around saying, I have this giant stack of cash and I'd like to deploy the capital so that I can make money while I sleep, not just while I trade. And all of a sudden, people are coming to you with investment opportunities. They start falling out of the sky. And then someone comes up, I got this Bitcoin thing. I got this Bitcoin thing. Let's make money. Let's get rich quick. And you look at it like, oh, son, thanks, but no thanks. Good luck to you. Because you're the smart money. You're the investor. Cool, right? Now, can you think 10 years ahead is the question. And then can you act 10 years ahead is the next challenge. Not even, I mean, if you can think it, that's great. But thinking is easy. Having a vision, putting a vision board, if I can only see it. Okay. That's good too. But you got to do it. Action. Okay? You see? Action. No one gives a dang about your vision. Think about it being a venture capitalist. You sit through 1,000 pitches and you make one investment. Nobody cares about your vision. They care about your client base, your revenue stream, your potential to partner, what names are you working with, right? They want action, tangible action. So over the next 11 years, oh yeah, you can do it. The path is there, sure. And people do it, by the way. But you have to do it. That's what people are interested in. So you're like, you only got $1,000 in your trading account? Cool, grow it at 5% a month. Yeah, right, Brad? That. I know it's not big money. Someone might look at your $1 million Forex fund and say, well, that's just $1 million. It's nothing. I know people that make $1 million a week. They're like, you'd be pathetically small. Well, you feel like your $1,000 account is pathetically small. When it's $1 million, people still think it's pathetically small. So what's the difference? Either way, it's pathetic. Start. Turn something pathetic into something meaningful. All right, Brad, lead us. Where do I start, Brad? Pick a chart, any chart. Pick a chart you like, man. Brad does his homework. What do you want to do? Yen just spiked, huh? Yen spiked. Could be that change in policy. Oh, I don't know, eh? USD kitty cat, cool. Okay, cool. Let's do it. Let's go. Let's go. Ciao. I guess we'll do this one. Oh, for shizzle. Oh, for shizzle. Okay. Okay. There is and there is. What does this say? According to the beginning, in the beginning, there was a central pivot point. Okay? Which predicts this price here. 131.41. 1.3141. Okay, we're all on board. You knew that 14 days ago. Actually, you knew it a little earlier than that, but we'll keep it there. Okay, and somewhere in here I said you need to make a choice. Is oil going to 60 or is it going to 30? So we put all this together, right? The prophet of profit. Okay, cool. So that's that. Now, let's extrapolate further. Okay? Based on this right here, we are expecting 131.97. 1.3197. Okay? And there's a bit of a gap between those. And so now you have to have chosen. Okay? Because this is actually a range. So let me actually do this. Okay. Now we are expecting, it has the potential for 131.41, but I can't quite read it, but I think it's basically, I think it's 1.32, I don't know, 03, I can't quite see it, to 131.41. 1.3141. Okay, so this is what we knew 14 days ago, eh? This is our presumption 14 days ago. This is our assumption 4 days ago. So where could we find some sort of congruency? Well, these things here kind of look like the same number, right? And that's the whole part of this chart template. You're supposed to say, well, is there a meaningful difference between 131.97 and 132.03? No. So if all you saw, right, was one or the other, you would have to react. But because you see both in this chart template, you say, oh, this and this combined gives me this. Oh. So now you have to make a decision. First of all, there was a high probability yesterday of taking profit. The bears would take profit. It was part of this trade plan. It was part of this trade plan. And that's the congruency on multiple time frames. Swing trading and position trading. Okay? Swing trading, you're in it for the week. This is a boring, basic. This is, by the way, as basic of a swing trade as you can get. And this is a position trade where you're in for a few weeks, maybe a few months. This is in, you're only in for a few days. And then day trading inside of that, I think you would also find that inside of all of this, there was a day trade here, there was a day trade here, and you know, so on and so forth. So there's, you know, I'd say there's about 5 trades on this chart, okay, in that time frame. Now, here's your alpha. You need to decide whether you're taking this downtown. or do you pocket the change? I don't know what's going to happen. Okay. We knew here, though, a bear would sell it and their swing trade is to get out here. Then we know a bear would sell it and their swing trade is to get out here. So now you're saying you need to decide, are you going to sell it at 133 and go for here? It's the same trade as this. This is a swing trade. This is a swing trade. This is the next swing trade. But the one thing that you now have to add to your risk profile is that this is where many, 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 many bears stop bearing. They stop bearing the risk. Bears, many, many, many. We don't know how many. We don't know if a majority. That's your decision. But we know that is likely where bears stop bearing. It's where bears stop selling. So here's the thought process. Let me clear this up. Here's the thought process. What is likely to happen? Okay. Potential number one, pachow. Potential number two, pachow. And potential number three, pachow. Those are the three things that you would anticipate if you're a bear. Okay? This is what you should have done yesterday, of course. And you could say, well, I'm going to pay close attention to this 21. I'm going to pay close attention to, I don't know, something. And you decide whether you should exit here where it's obvious. And maybe you can get down to S2. Maybe you can make another 50 pips. Some people would say, you know what? I don't give a crap about another 50 pips. I got money in my pocket and the other one's hailing a peace sign. Done. In the bank, because here's what I always say. I have a speech I often give in a situation like this where it's the law of averages. If you were in this situation 100 times, how many times will it go down, or how many times would you give it up? So like how many times out of 100 do you make the extra 50 pips, or you give up the 50 pips because you were trying to get the extra 50 pips and you didn't make it? Okay? Do you most often get down here, or do you most often do this? Well, if you just always got out, okay, you split the difference. You see? You just split the difference. You're like, well, why give up 50 pips? Because that's where you'd move your stop to. Why would you give up 50 pips to make 50 pips when if you just took the profit, you would have the average? But here's the thing. You're not in the trade anymore. You're sleeping at night. You're playing with your kids. You're I don't know, walking dogs at the dog shelter. You're a docent at the museum. And you're not doing this anymore. You're done. And you're like, wonder what's going to happen. Because you're done for the month, by the way. Here's what you planned for the month. Here was your monthly plan. Remember this? You're like, okay, this is obviously bearish. I'm going to sell it down here. I'm going to exit. Good. You're done. What are you going to do in the next 2 weeks? Have you thought about it? What are you going to do the next 2 weeks of August? You're done. And the thing is, there's a high probability, as I've already explained, for something like this. So the worst case scenario is you stay in, you lose 50 on the op here, and then you try again, and you lose another 50, and then you gave all this profit away, and you're like, you should have just took time off, dude. Have some discipline. Okay? It's hard. I'm telling you, it's very difficult to do this. Knowing how to not trade is very, very, very difficult. Oh, Guy got the Alanis thing. Yeah. Got it. You got to be interesting, right? Only if your college professor was. I'm telling you, I need to do at least one class at Harvard. Okay, so you have to be able to like. Some people say stack them and pack them. Well, you have to know how to unpack them too. So this is an obvious trade. This is an obvious trade, but this is also an obvious exit. Okay. So what is next week going to hold for us? Well, I believe a bear is going to try. I just don't know if a bear would succeed. And if so, I'd probably get out closer to 131.50. I wouldn't go for this 131.27-ish area or 131. I think I'd probably, if you get in here at 133 and get it down to 131.50, you should be tickled pink. You squeezed blood out of a stone. All right? Have you ever squeezed water from a stone? Mickey Mouse. I used to read the book to my kids. Why, you're not afraid of me? Afraid of you? Why, I'm here to challenge you. And Mickey Mouse pulls out a piece of cheese, a round piece of cheese, and he squeezes the cheese and water comes out. And the giant's eyes widen with fear. And he says, right? And if you don't leave this town, why, I'll squeeze you. Whoa, says the giant. Yeah, come on. Yeah. Hey, man, you got to raise kids. That way you can do Mickey Mouse voices and I can't get the honey from the honey pot. You got to have all the voices. Yeah. I used to be a currency trader once. It's a tough gig. Anyways. So now you can see there's opportunity next week, but with a little additional risk. And that additional risk is an opportunity for bulls next week, which may or may not take away some of your net worth. Hi-ho here. Right? Oh, I used to be able to do. Right? Hi-ho here. Kermit the Frog for Sesame Street News. I don't know. It's in there somewhere. All right. La. Yeah. So there you go. There's that. And Brad's in the War Room group, the previously known as Swing Trading Group, and we ripped apart oil data. So he's got all of that in the back of his mind too. So you watch. Brad Hall, Braddy Boy, Mr. Hall, Hall of Notes, Boys in the Hall. He's smart money. Who the hell are you? Yeah. Hall, yeah. Haul an ass. Wait, that's probably inappropriate. All right, so, okay, so yen's moved. Yeah, KG got Ehor. KG's like, I'm feeling it. The Ehor. All right, so we got some yen strength across the board. So as you can see, there's some congruency. It's Japanese yen strength. You see all the head and shoulders, the crowns, the double tops of double tops. You see all these things we've been talking about? Are you starting to see them? So you should spend some time at the Central Bank of Japan, otherwise known as the Bank of Japan. You should probably spend some time there over the weekend. Is that right, Brad? No! Hey man, you gotta find your foundation. If it helps you not eat your stack, if you can live on that and save for Forex, cool. Because I know a lot of those financial advisor programs, they're like, hey man, you get to sit here for 6 months and study for the Series 7 and we'll pay you. And you're like, what? That's right. And then you go through our, emerging manager program for a year or two and you work on a team and they'll make you cold call, right? And you get paid basically for 2 years to do nothing, right? So if you can do that, that's awesome. But I sincerely hope that you become a wildly successful hedge fund manager, right? That's what I want for you. But let me know how it goes and who you went with. And okay. Stay involved. I'm going to be in Miami as soon as they open the borders. We're going to be drinking booze and smoking cigars and laughing and cackling. So hopefully you're there. 40 calls. Yeah, so if you're not doing more than that, man. I had a job. It's not even on my resume. It's not even on my LinkedIn profile or all that. But I worked for a company called Payne Weber. And his name was Tad. I worked for a financial advisor. I can't remember his last name. But it was really cool because I remember you'd go into the office and everyone's shoes were outside the office, outside their office door. And so the shoe shine guy would come in the middle of the day and shine everyone's shoes in the fire escape and put their shoes down. And so I remember like you'd walk in and all these, financial advisors are wearing suits and ties, walk around barefoot because they always got their shoes shined. And then the other thing I remember is as people are connecting to the internet, you can hear modems dialing. Amazing, right? Just fun. So anyway, so they said I was an executive intern or something like that. So what they did is I had my own office, which had a view of the back alley. But hey, man, I had my own office with a window. And the whole office there was a desk, a phone, and shelves full of leather-bound books. But they were the Dun & Bradstreet books. And you'd grab a book, and you'd grab a book, and it's like the size of a phone book. And you open it up, and it just had a stack of rows of tiny font. The font was so tiny you could barely read it. And it had the name, occupation, household income, and a phone number. So John Smith is in Indiana. He's a medical doctor, we'll say, and has a household income of greater than $500,000. And here's his phone number. And my job was to call everybody. One book probably had, I don't know, 100,000 names, and there must have been 100 books, maybe more. Call them. That was my job. Call them. Tell them about the exciting opportunities in annuities. And I'm like, what the hell is an annuity? They're like, it doesn't matter. Get them on the phone. Yeah. So yeah, 40. I can do 40, but before my first coffee break. Sure trade. Yeah, join. Yeah, that's actually funny. Sure trade. So, anyways, can we have a look at Natty? Sure, but what I'm showing you right here. Let me go back. Make sure you don't miss it. I just asked you to go to the Bank of Japan's website and figure this out. Right? Like, I just dropped massive knowledge here. Like, looking at Nat Gas, like, it's such a microcosm of just this giant piece of knowledge I gave you. I'm like, where Nat Gas is right now, not interesting. You need to figure this out This might be a big, 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 big change in the market. Big. We don't know, but you need to get on the clue train. Nat gas doesn't matter. Okay? NWM, Wealth Management. Oh, Northwestern Mutual. Yeah. All right, fine. Hey, man. Good. I hope they pay you a bunch of money for a couple of years. You live off that, Brad, and you keep hustling. You keep your head big. You keep your mind big, and consider it a stepping stone. And maybe it's a nice way of showing someone that you have experience in the industry. You're like, yeah, I was a financial advisor. But let me tell you why Forex is so much better, right? I want you to look at it and stay big, Brad. You got a special mind, and it needs more. Okay? It needs more than churning your customers to get some commissions and sitting on their net worth, earning 1% because you bought a bunch of mutual funds. I mean, come on. You're not going to survive in that. Yeah, no, but I'm just saying long term, it's easy to get in it because it's easy money. Being a financial advisor is easy money. People pay you to buy mutual funds. Why can't they just buy the mutual funds themselves? They pay you money so you can buy the stock market. Well, just buy the S&P 500. They don't have to pay you 1%. Just buy the S&P 500. Done. Oh, but the diversification. S&P 500 is diversified. That's why it's there. Like, they could pay someone 0.000125% and get diversification and exposure to the market. And they're getting the beta. They're not asking for alpha. And most financial advisors don't have any alpha. They barely outperform the market, especially when you subtract fees. So I don't think you're too smart, Brad, where sitting on someone's portfolio of mutual funds and siphoning off 1% is easy money. But now you got to pay the broker you work for. They're going to take at least 50% of that to pay for, the client associate, and to pay for the office, and to give you the business cards. So at the end, you're only earning maybe 0.25%. And you're like, because you bought old ladies' mutual funds, and you're like, dude, I can't do this. You're just like, I can't do this. There's just no way. You should talk to a wealthy person that says, you know what, Brad? I'm wide open. Tell me how we can get going. Let's do something interesting. I got 5 apartment buildings, right? I got stocks up the yin yang. I got some guy tried to pitch me on bonds, whatever, man. But Brad, what do you got? Let's do something fun. Let's do something creative. Tell me how I can buy a bigger yacht because of you. You're like, oh man, you just opened Pandora's box of profits. Right? Yeah. Okay? I'm telling you. You got this, man. You got this. Stay big, man. Stay big. Stay big. Easy money. It'll get you, after 20 years of work, you'll make $300,000 a year. I remember one job interview I did. I haven't done many, but there was one at a major. I think it was more of an insurance company that also did financial advisory stuff. And so, anyways, I talked to the owner. We had lunch. It wasn't really a job interview, but we went to lunch. And anyways, I'm like, so the idea was there was sort of an intimated, like, would you ever work for us kind of thing. So we're having lunch, and I'm talking with him, asking business questions. And he kind of threw it out there like, no, so if you were with us, what would you think, right? And I said, well, how many people in the office make $1 million a year? And he just froze. And I said, well, if someone came in and they were better than the best believe they're the baddest, like broke records, are they going to make $1 million a year? And he kind of like, well, I suppose it's possible. And I never talked to him again. That's that. Right? Like, but that's the thing. You got to be your own boss. Otherwise, you'll never make that kind of money. All right. So, pound, whatever, pound. I don't know. I did a 4-hour webinar or live stream yesterday. Maybe we should do it short. I guess it's not even short. It's been $1.23. That might have been because I ran it for a while before starting, huh? What do you guys want to do? I mean, I don't know. Like, I slapped somebody down, and I apologize. I know I did it. I apologize, though. Like, let's look at nat gas. I'm like, you know what? Like, it's just what we've talked about today, and in particular, like, go do this yen homework. It's so much more important than anything else. Like, what is the Aussie dollar doing right now? Like, WTF. It's so small compared to what we need to be thinking about, right? Especially if you're like, so what's it doing today? Today, okay. So what are you going to do like next week? So I'm looking at Aussie dollar, and what's it doing? Look at, is it going? Is it sideways? Is it down? Is it up? Like, look, is it down? Is it up? Is it sideways? Is it down? Is it sideways? Is it up? Yeah. Yeah. From nowhere. Imagine there's 10 traders and they're all in different time frames. Okay? And they're looking at this from all points of view. One says it's an elephant, the other one says it's a giraffe, another one says it's a cow, another one says it's a chicken. You're like, wait, how can it be a chicken? It's got 4 legs. Well, I only see 2 legs. And someone says, well, how could it be a giraffe? It doesn't have a long neck. Well, I can't see the neck. Right? And we can't come up with it. It is bullish, it is bearish, it is neutral. Yeah, Daniel. Well, from your point of view, but it's a dragon, right? So that's where I kind of caution myself. It looks like this month we haven't had step ups. So, okay. Now, long term, this is important to me. What are you going to do next week? Well, if you're a front running bull, you had an opportunity earlier today. If you're a front running bear, you're going to have an opportunity right around here. So that's where you have to like measure it out now. And you would do, let's say that since the beginning of the week. So another way of doing it, because I don't like that, I would say, got to connect these somehow. You want to use an Andrews pitchfork? Let's do a pitchfork. Insert Andrews pitchfork. So where's the beginning of the trend? Where are we measuring? This is the problem. Are you going to measure here, the beginning of the week, or the top? Okay. And then you measure what? The lowest low, and then you measure the highest high. See? And then you're like, that doesn't quite work. So now you start backfilling your data, and you're like, well, what if I do it here? Well, what if I do it here? Oh, that works so much better. No, I think I'll like it here. See, that's, right? That's the problem. Okay? Where you're like, that's not the highest high. This is the highest high. Wait, that doesn't work. So no, I'll go back to this highest high. Okay? So you do this. Okay? Let me see if I can get rid of that part. Okay. All right. So you go from the beginning of the week, let's say, and you say, I guess that's close enough. You say this. If you are a bear, you're going to take that. Oh, look, I already drew it. Or if you're a bull, you're taking that for the front run. This is a front run, and you're front running next week, depending on if you're a bull has already done it, a bear is going to do it. In between all of that, I see not easy money. Okay? I want the easy money. I want the low-hanging fruit. Okay? So you do something similar with every single dollar pair and see what's up. Do the same thing with every single yen pair and see what's up. What's up, yen? Next week, KG. Peso! Peso! Okay. Ow! So peso. Ow, ow! So peso. Ow! So peso. Okay. Pretty cool. Seems like a downtrend. Seems like we're going to exit at 22. Oh, we hit 22 and it's bouncing. I know, right? So now let's extend this further. If nothing changed, if nothing changed, that's what next week would look like, right? So how would you do this if you were still a bear? You would say there's going to be some up and then there's going to be some down. Nice! Let's do that again because that was thick. Let's go thin on this time frame. There's going to be some up and then there's going to be some down, let's say. Oh my gosh, what? Now, on this time frame, do you see the cautionary tale? Where's the cautionary tale? The risk. What's the concern? You didn't see it on the small time frame. That's why you got to back yourself up. Think big, look big. No, I wouldn't say bulls. That's not. Consolidation is one of them. So let's do that. Consolidation. Based on price action, we have a market. Oh, now I got to get fat. Let me get fat here. You got a market that says this is the trend. That doesn't look like a great trend, does it? What else should we be worried about? Let's say we get down to 22. Or even 21.66.5. Do this, don't do that. Can't you read the sign? Okay. There's some risk built in. Could be some risk coming in. And we're coming up to the third week of August. The third week of August. Could be interesting. Could be interesting. Stampy. Look at the range, Stampy. Huh? Could be interesting. Next week could be a doozy. It could be technically important to see what we do in this zone, but not just here, everywhere. You guys knew what I just did? Oh, you guys are sick. Signs that you wasted your childhood. Cool. Cool. Peace on earth. May the pips be with you. May your profits be above average. May you have a wonderful weekend. Study the Bank of Japan. I will see you next week. Thank you so much for being in my life. I gotta go. Boom. Boom, shalakalaka. Thank you, Traders Way.